Welcome to the Finance Story. Today I have with me Anil Achyuta, who is a friend of mine, but he's also the founding member of TDK Ventures in the US. They're doing some great things. He's also voted as one of the top young VCs in North America. Anil, how are you?
I'm very good. Thanks, Vishal, for having me here.
And I want to set the context of life. As you say, it's about continuous transformation, continuous change. And in your case, you were a cricketer, right? And then you went to the US, of course. And you transformed yourself into becoming a scientist. What drives you to succeed, Anil?
Oh man, I don't know. I mean, the short answer is fear of failure, right? And I think, it really comes from the deep-rooted middle-class upbringing, right? You're constantly exposed to individuals and people who are way more well off than you are, and you kind of think about it and you say, okay, what is it that I need to do to make an impact? I tried to create impact by being a scientist, which is to create products, create technologies that will help the real world. And for me, going from cricket to science was really it's a necessity thing. I wasn't that great of a cricketer, and I was good enough to play in the sort of the smaller leagues, but many of my colleagues and friends are now playing in the IPL and all these things. So that transformation was really a necessity thing. When I realized I wasn't good enough to make it to the next level, and I had to come back to reality and say, okay, what is it that I can do? And I remember one instance that was quite transformative for me was I met my uncle from the US. He had come in and he asked me, why should anybody hire you? It was a simple question. And I thought long and hard about it. And I realized I really had no salient qualities for an employer to hire me. So I made it up to myself that I said, okay, I want to be the best at something. And that told me that, okay, I should probably go to the US and maybe pursue science as a career and see if I can do something to create that impact.
That's a great answer. And I also have to tell everyone listening to this is also going to the USA was not easy for him. He had to start off at research in IISc for a short while, get a full scholarship to go to the USA. So tell us about that.
I've gone up and down and down and up and so on. And a simple example is I graduated with my Ph.D. in 2009, which was the worst time ever to find a job or try to look for a job. And I remember applying to about 190 companies or something like that and getting one call. I got rejected 189 times. Basically, rejection is not even a rejection. They didn't even send me saying, okay, we reviewed your resume and sorry, we cannot qualify you. It basically was no response, right? So, and the one call I got was from this company called Allergan, which is now owned by another bigger pharma company. And they, I think, spent 5 minutes on the phone with me and quickly realized that I really, again, didn't have many salient qualities that they were looking for. And that was a rejection. So it was very frustrating for me, that experience, because I had just got my doctorate. I was 25 years old and I thought the world is my oyster.
Talk about TDK Ventures, and you guys have lots of unicorns in the portfolio, right? You had one IPO, you had two M&As, right? 26 portfolio companies. Correct me if I've got the numbers wrong. 26 portfolio companies,
right,
or larger.
The only thing I want to say is soon to be unicorn. So 500 million plus club,
How did TDK happen for you?
So first, I'll also answer the TDK Ventures story. In short, the beginning story was that of my boss, Nicolas Savage, whose company, InventSense, got bought by TDK. And he had to figure out what to do with his life next. So for him, TDK Ventures was the next project because he went to a class at Stanford, and there's this one amazing professor, unnamed, everyone knows him. And he told him how many ways can a CVC die or a corporate venture capital arm die, and why it's a bad idea to start a corporate venture capital fund. And Nicola felt that, okay, if someone's saying that, you got to set the record straight, right? And he also met this guy called Paul Holland. He was the former general partner at Foundation Capital, which backed Netflix, Chegg, etc., Uber, a bunch of amazing companies, right? And he's been there, done that, several funds. Paul came in as a guest lecturer at the Stanford class, and Paul said, "How can CVCs actually work?" And for him, these diametrically opposing views gave an impetus to say, okay, let me go and talk about why TDK should do a corporate venture arm, specifically focused on the exploration mission. Meaning, we are explorers, we want to look at the world in the future, and we would go and invest in these futuristic things. And the simplest argument that we make is the following. If TDK Ventures was alive in just 10 to 15 years ago, we would have backed Tesla, because we would have learned everything about electrification, and we would have designed in all of our electronic components, because TDK is an electronic components business and we sell components for a living. We are a little bit like Intel Inside, right? So for him, it was important to invest in companies that will define the future of TDK. So that exploration mission resonated with our CEO quite well. And our CEO apparently 7 minutes within the pitch, he was given 20 minutes. At minute 7 or 8, he basically stopped Nicola and said, "That's exactly what I'm looking for. I'm going to grant you $50 million to go and invest in these things." So that's the TDK origin story. I'm happy to kind of go in deep.
Yeah.
I think that's
now it's about 200 million AUM.
Right.
What does impact mean to you? Because
it's a simple concept for us. Impact is triple bottom line, right? First is financial impact, meaning we are like any other VC. With every single investment, we want to return the fund. It's very simple. If I invest in one company, I want to be able to return $150 million. So if I get 10% ownership in a company, then basically that company should exit about 1.5 billion in order for me to return the fund. It's as simple as that. So if you are thinking about small ideas, we are usually not interested in that. Second is strategic impact. TDK will craft its strategy by backing the king of the hill, right? The number one, best in class. Why? Because everybody is looking at number one. You don't want to back the number three, right? Because the number three guy is looking at number one. So what you want to do is you want to back the number one who's setting the trend, setting the bar, and TDK kind of drags along with them, right? And if it happens to be very strategic, then perhaps an M&A from TDK is also warranted, right? Third part on the impact is good to the world. So we use United Nations Sustainable Development Goals for determining what's impact or what's sustainable. We want to obviously provide clean water, provide healthcare access, and so on and so forth. So it's very plain vanilla for us. So triple bottom line is what we look for in investments.
How does a VC build a great portfolio, be successful, right?
So I think when you begin a fund, you want to invest in slightly earlier stage companies. Again, it's different for different people. This is the way we think about it, right? Because it takes time for these companies to mature. It's like any other crop, right? You put a crop and it takes time for the crop to grow. Sometimes the crops die. So what you want to do is you want to invest early in the fund cycle, because we have a certain cycle of deployment. We cannot deploy forever, right? That makes no sense. Because you could just get interest rate on the market. Of course, the market is crap today, but the point being, you want to invest early into companies that are transformational. And as the fund grows along, you make a few later stage bets that will give you some exits. Because ultimately, it's like any other sport, right? You gotta be in the game in order to play the game. If you're out of the game, you cannot complain. It's like cricket, right? You cannot complain once you come out and get out, right? Oh, I should have hit that. I should have done this. No, you didn't do it. You're out. right? So how do you strategically build that portfolio is you got to get enough exits to show your LPs that for the next fund, hey, I'm returning money back to you, but I'm also creating transformational companies, because there's some failure rate involved in VC, and it's a power law as they talk about it, right? If it's a normal distribution curve, 66% on the either side of the mean, 33% are going to be ordinary, right? It's kind of average, and you get fat tails. That's what most people think VC is, but that's not true.
Yeah.
What VC is 80% of it is just ordinary, or more than that is ordinary, or some of them is zero. It goes to zero, and one or two of them really strike. So if you're taking a $150 million company fund, what you want to do is one or two of these will return the fund, and the rest will be ordinary, right? So then you can make a very good case with your LPs. Some of the people I know, advisors of TDK Ventures, DCM, I think, partners, one of our advisors, the last fund they took 350 million and returned 11 billion. I mean, wow. Can you imagine returning on the fund scale, right? Fund scale, they're doing 20x. It's not an investment scale, right? It's easy to do a 20. I mean, I cannot say it's easy, but you can get lucky once in a while, okay? But returning funds at 10, 20x, boy, that is Hall of Fame. I mean, that is, your Virat Kohli or Sachin Tendulkar style return, right? Over a long period of time, getting that.
No, that's what I'm saying, right? How do you know that these founders can do it for you?
Butterfly, it was a very unique story, right? I say that with no pun intended, because TNU, who's the founder, had a drone company called Yuneec, or Yuneec. Funnily, and Yuneec was actually one of the biggest competitors for DJI, which is the largest consumer drone company in the world. And we knew that, and Tien was a helicopter pilot. So we knew that he knows aviation inside out. We knew he could build amazing drones. What we didn't know is whether he could build a proper flying car company, right? So it was more, at the seed stage, what you do is you really back the founder. And if you know that the founder is credible, and if you can attract people, I think that's the number one thing as a founder, right? You've got to be able to attract people for almost no salary, because these people are also, pulling 6-7 figure salaries in big companies, Uber and all, Amazon. These guys pay like crazy, right? If you're able to attract talent like that, then you know that these people will deliver. Of course, there's risk involved in seed investing. I'm still learning how to do very good seed investing, because I get too sort of product driven, more of a later stage. I'm learning to be a little more empathetic. I'm not sure if I'm very good at it yet. What you want to do as a VC is you want to surround yourself with people who are unbelievably smarter than you. Like, not just one step smart, right? 10 times smarter than you are. And the more you surround yourself with people like that, then you tend to dream about a world that doesn't exist, and that dream becomes a reality.
You start perhaps at the idea stage maybe, and how do you plan for Series A, B or C with your startup also?
Yeah.
And also ensure that they go to that level, and they have to go through that rigor.
Yeah. Well, first you have to find companies that can actually survive, right? You cannot invest in companies that are just hyping. You have to invest in companies that transform the world, right? And you got to build a syndicate of investors who could actually achieve that. If they don't believe that, then there's no point in investing. Yeah. Second is, when you're raising your seed round, what you really ought to think about is who's going to lead the A round. So you're really fundraising for your A round, not really your seed round. So when you put yourself in the founder's perspective, the biggest time sink for you is fundraising. And the funny thing about fundraising is it usually takes about 6 months. In this climate today, it's about 9 months, or probably worse. because the hardest part is to find a lead for your next round of financing. And people go up and down and back and forth and so on to find the lead. So what you ought to do as a founder or a venture capitalist is to build a syndicate where people have deeper pockets, meaning you cannot surround yourself with people who are not going to support this company for the future. Financing, let's say you're doing a $5 million round. Let's say your lead is doing $3 million. You've got to ensure that the lead can actually come in and do their pro rata or their future investment into the company and help the company along. But also that lead investor should know other lead investors who come in and lead the A round. So, and when you're doing the A round, you do the B and so on and so forth, and all the way up to the IPO. So it's a little bit like orchestrating a symphony. You got to be able to understand who can actually make that beautiful sound from one instrument. And when you put three instruments together, it becomes like an orchestra.
How does TDK follow on its investment strategy? For how does that work?
Your first check is going to be the biggest check that you do, and it's the lowest cost of capital. If you think about it in that way, because the valuation is actually very, very low compared to whatever it is the next one. As an investor, you want the company to get the biggest valuation in the next round, right? Which also is a headache for you because your pro rata is going to be that much higher if and your ownership is going to be that much lower for the next round. So should you really do pro rata? There's a school of thought that says, well, it doesn't really matter as an investor. But as a value-added investor, you ought to invest in the next rounds. And there's also a little of signaling effect to the other investors saying, hey, TDK Ventures is following on. That means they believe in the company, they continue to believe in the company. So it's a little bit two-sided, but from my perspective, what I personally want to do is I'd like to get close to 10% ownership in a company upfront because of very simple reasons. Because we're a size 150 million, and if I don't get that 10% ownership, then it gets that much harder for me to catch up to it. Because next time I got to put in a much bigger investment in order to get to that level and to return the fund. Of course, I don't want to, I won't be able to return the fund with every single investment, but I want to get in the same order of magnitude. So let's say, if it's a 50 to 75 million return, then that makes me more excited about investing. But if it gets any lower than that, then it becomes kind of like, okay, should I really do this? Is it really worth the time? Because I'm on 5 boards right now, and I've made 11 investments, and I've made, 2 of them have exited, and I have 9 children, along with my actual child and another child I'm having. So these children need time, and it has to be worth the time.
You need to also think about investor syndicates, right? These syndicates are the ones that are going to help you around. How important are investor syndicates for you?
Absolutely critical. Not important, critical. And the reason why I bring that up is a startup is like a little child, right? Little children are very, very fragile, and ideas are very fragile at the early stage. You can kill, ask someone how to kill a startup. Anybody can kill a startup, okay? It's very easy to kill a startup, but it's very difficult to nurture one, right? So, my philosophy is always, I would rather sacrifice my ownership to building the right syndicate. So that's my sort of trade-off that I use. For example, for Verdagy, right? We brought in, it's a green hydrogen company. And the first thing that we thought was, okay, how can we help Verdagy beyond adding this whatever initial investment of $5 million that we put in? And the first thing we said was, okay, first thing we need to do is we need to find customers for Verdagy who would pilot this and perhaps provide a scalable advantage to Verdagy. So we brought in Shell Ventures. And Shell Ventures, Shell as an oil company utilizes hydrogen at a massive scale for certain processes, reduction processes. If we could replace that dirty hydrogen or gray hydrogen with green hydrogen, guess what? They get a much lower carbon footprint, and that for them is better. So yeah, building syndicates or dream syndicates as we call it within TDK Ventures is a part of our life, and we take it very seriously. And this is how you build unicorns. You asked me, how do you build unicorns? This is one way to build unicorns. In fact, I don't want to build unicorns anymore. I want to build dragons. Companies that are valued over 12 billion. I've coined a new term for companies that are worth more than 30 billion. I call them mother of dragons. I'm a big Game of Thrones fan, so.
Why not? You should be. I mean, with a little bit of pop culture, we can take you a little more further.
I believe the best founders are the most attuned to the financial world. Even they are scientists. In fact, it is one of my strengths to look at both the financial side on the business side and also on the technology side, because I have seen n number of flips in my life where I think that this is the greatest thing since sliced bread, and it just goes to zero. And it's just so frustrating as an innovator that you have to be disciplined from a financial perspective. If I see any form of indiscipline on the financial side from anyone, including the engineers, I would actually discount them in the team, because I want everyone to be like that. Now, having a professional CFO, absolutely at the right time. Not at the seed stage, not at the A stage, maybe at the B stage, right? When you're getting scaling and becoming a bigger company, I think having a professional CEO is very important. And I think at different stages, right? Like for example, we invest in a lot of hardware companies, and these companies go from equity financing to debt financing over time. And the moment you start transforming yourself to a debt financing, you need a proper CFO, because that is a lot of debt equity mix, and it really helps you reduce the cost of capital. And also when you're going public, it really prepares you to become a proper company, and you need the financial rigor. And even as investors, we cannot provide that, because none of us are trained financial people. We actually have a financial principal within TDK Ventures who comes in and does a lot of modeling and helps companies and so on. But of course, it's more of an ad hoc kind of support. It's not a full-time CFO or anything like that.
Okay, great point. A lot of companies are raising 100 million upwards. A lot of young people, when a $100 million check hits, most of them go rabid. I mean, most of them go to shrinks. What is your advice to the young when they have that $100 million check?
Well, I mean, first thing is they have to focus on building great businesses, right? Because ultimately, I mean, you've seen how the market goes up and down and up and down, and it is critical for people to just stay boots on the ground kind of thing, right? Just stay humble, and surround yourself with people who are genuine and trying to build a company. And again, my sports analogy comes very, very true in this case, is that you do the same practice, you do everything the same. One day you go in, you score 100, and then another day you come back with a 0, right? And it's just a part of life. So for me, I think I look for founders, and my advice to founders is, don't overestimate your success and don't underestimate your failure.
Ladies and gentlemen, if somebody's building the mother of dragons, it is the TDK Ventures team. Go check out their portfolio companies. Thank you so much, Anil.
Thank you, Vishal. Really appreciate you having me here.